Good afternoon, everybody. Welcome to another episode of OIC's in webinar series. My name is Mark Benzequin. I'm the manager of the Investor Services team here at OIC. I hope everyone's doing well and staying healthy in these unprecedented times we find ourselves in. We also find ourselves in a period of unprecedented turbulence in the market, certainly these past few months. So much so that businesses have been slashing and even doing away with dividends altogether. It's not unusual that we see mention of a new business reducing or doing away with their dividends altogether. And how this affects your options position and your options trading is something that we're going to be exploring today. So for those of you that are new to OIC or new to options trading, we certainly are going to have some enlightening information for you. For those of you that are a little bit more intermediate or advanced, certainly we'll have some concepts that will apply to your options trading as well. So welcome everybody, have a seat, relax a little bit, and for the next 60 minutes we're going to explore some interesting options concepts. Before we begin, however, we need to do our standard disclaimer. Please note that options involve risks and are not suitable for everyone. As a matter of fact, for those of you that are new to options trading or interested in beginning with options trading, your broker will require you to acknowledge that you have read and understood the characteristics and risks of standardized options booklet. You can get a copy from us here at OIC or your broker, or simply go on our website, optionseducation.org, and download an electronic copy. We're also going to be keeping things simple by not discussing some of the different financial costs that will affect your transactions, such as commissions and fees, interest rates, etc. Please know that these costs do impact the bottom line on your trade, your profit and loss, as well as taxation. So if you have questions on that, please direct those to your broker because they will vary from firm to firm. And as OIC is simply an educational outreach of OCC, which we'll discuss in just a moment, these strategies and concepts that we'll be discussing today are simply for educational purposes and not intended as an endorsement or a recommendation to trade options. Speaking of OIC and the OCC, the Options Clearing Corporation, OIC is the educational arm of the OCC, where we offer free and unbiased professional options education. We do that mostly through our website, optionseducation.org, where we offer online courses, podcasts, videos, and this critically acclaimed webinar series. Also, the pride and joy of the OIC and OCC is our investor services desk. You can reach options professionals via email at options@theocc.com or via live chat if you prefer a one-on-one interaction on our website. And speaking of the investor services team, we do have Mr. Bill Ryan, who just recently celebrated 20 years at OCC, on the line with us today answering questions, as well as Ken Keating, another options professional who spent a couple decades on the trading floor. And then myself as well, Mark Benzequin. Again, between the three of us, we've got over 75 years of experience in the options industry, so chances are if you've got an options-related question, we'll be able to answer it for you. So definitely feel free to reach out to us. Options@theocc.com is our email address. Or for today's presentation, there is a Q&A box at the bottom left-hand corner of your screen. Certainly feel free to ask questions as they pertain to this particular session. And throughout the session, Bill and Ken will be responding to you live. Any questions that we do not get to today due to time constraints, or any questions that are outside the realm of this discussion, feel free to simply shoot us a message, and we will respond to all of those questions by the end of the business day tomorrow. Now, that being said, let's take a quick look at annual options volume. I generally skip over this slide or go over this slide fairly quickly. For those of you that generally or regularly attend OIC webinars, you've certainly seen this often. For those of you that are new, I'll just simply point out that since really the turn of the century, options trading has really taken off, mostly from the use of self-directed trading as well as education. The more people know about options, the more options they trade. You can see that in 2019, OCC cleared just under 5 billion option contracts. So definitely a lot of volume going on over the last 20 years. And all of that volume happens here at the 5 parent exchanges, the BOX, the CBOE, the MIAX, NASDAQ, and the NYSE. If you have any questions about options volume or the particular exchanges, feel free to reach out to us. So let's go ahead and get started. Here is our presentation outline. We're going to begin with a quick recap of options pricing, including who makes up option prices and what is an option worth. We will look at the impact of dividends on options pricing, which is the crux of today's presentation, and then early exercise for option holders and the assignment risk for option writers. And we're going to finish up with what happens when a dividend is reduced or eliminated. As I've mentioned, it's an almost daily occurrence where we see that different companies are now reducing their dividends. So how does that relate to your options trading? And then something a little bit different, special dividends and option adjustments. So we'll get into that at the end before taking some Q&A. So we'll definitely have time for your questions. Again, feel free to submit those bottom left-hand corner of your screen. So let's go ahead and get into a quick pricing recap of options. And we'll start with the 2 general questions that we receive a lot here at OIC. Who makes option prices and what is an option ultimately worth? To begin with, who makes option prices? Well, that's a little easy to answer. It's everyone. All market participants, all buyers and sellers, whether it's individual investors like you and I, institutional investors, hedge funds, insurance companies, big banks, professional market makers. Those are the men and women that you see on the trading floor and in the movies waving their hands around and screaming at each other. Those are all of the people that make the prices. It's the best bid-ask consensus of all bids and offers. It's something that we call NBBO, the National Best Bid, Best Offer. And basically what it amounts to is if you're looking to buy an option and you are the best bid on the street, meaning you're the one willing to pay the highest price, your price is going to be reflected in the market. If my offer is the best, meaning that I am the individual that is willing to sell that option contract at the lowest possible price, that offer will be reflected on the street. So who makes option prices? It's all market participants. It comes from everybody. It's you and I, as well as pretty much the tens of thousands, if not hundreds of thousands of other market participants. Now, what is an option worth? That's a little bit more difficult. An option is simply worth what the market is willing to pay or what the market is willing to sell for. To put it a little bit more simply, every year, or to give you an analogy, every year you hear of somebody selling Super Bowl tickets, for example, for $10,000 a ticket. But that doesn't necessarily mean that that's what the ticket is going for. If nobody's willing to pay $10,000, then it's certainly not worth $10,000. I can turn around and list my house, for example, for $3 million, but if buyers are only willing to pay a fraction of that, guess how much it's actually worth. So when it comes to what an option is worth, you can use pricing models, which we'll get into in a moment. We can use pricing models as a guideline, but it's really only worth what somebody is willing to pay for it. And that is often determined by supply and demand and other market dynamics. There was a pretty famous electric car company that I'm sure most of you have heard of. And this Monday, there's been some pretty parabolic buying, which led to call pricing to skyrocket on this very famous electric car company. Investors were buying up the options till the cows came home. Unfortunately, the cows came home a little earlier than they expected, and the shares finished actually down on the day. The point being is that while we can say an option is worth X amount of dollars, or a pricing model can determine that an option is worth X amount of dollars, what really matters is what somebody is willing to pay for it. And sometimes supply and demand, or in this case, demand for those options or other market forces, market dynamics, may render those pricing models useless. But supply and demand is a major function of options pricing. The more people that want to buy something, they're going to be competing against other buyers, and the only way that they compete is by bidding higher prices. Conversely, with the supply, the more people looking to sell an option contract, for example, they're going to have to compete with other sellers, and the best way to compete when selling is to lower your price. So supply and demand, it's a very basic economic principle, but it's also a fundamental principle of option pricing. Now, that's not to say that pricing models don't have their use. Pricing models are often a good point to begin that negotiating process. For example, if I'm only willing to pay $1.20 for an option, and you as a seller are only willing to sell it for $1.25, then at the end of the day, we're both going to leave with an unfilled order. But if I use a pricing model where I put in these inputs, and these inputs happen to be stock price and the strike price, that's those two inputs right there, that is where we determine the intrinsic value of the option. If you're not familiar with the intrinsic and extrinsic values, here's a quick explanation of it. Intrinsic value is basically the inherent value of the option. If stock is trading $55 and I have a $50 call, it gives me the right to buy shares at $50, even though they're trading $55 in the market. Intrinsically, inherently, that option is going to be worth at least $5. And I get that value simply from the strike price and the stock price, the difference of the two. The other inputs, volatility, time until expiration, and the cost of money, which includes dividends, which is what we're going to be talking about today, that is known as the extrinsic value, or the time value. People call it time value mostly because time is such a major component of that value, time until expiration. However, volatility, interest rates, and again, dividends also play a role in calculating that extrinsic value. So the point being is, if I put all of that into a options calculator, it is going to spit out a call and put premium, a theoretical value of what the call might be worth and what the put might be worth based on those numbers. So if I put all of that in, and that model tells me that the option I'm willing to pay $1.20 for is actually worth $1.23, then, as my old boss used to say, I might be willing to pay a few extra shekels in order to get that order filled. So what a pricing model does is we input information into the model or the calculator, and it spits out a value to us. And that value, it's up to us to use as we want. We can use it as a starting point to begin the negotiating process of buying or selling options. And don't be fooled. It absolutely is a negotiating process. What I'm willing to pay is necessarily not going to be the same price at which you are willing to sell. So, we need to kind of, come to terms and have a meeting of the mind, so to speak, financially, in order for both of us to walk away with a filled contract. So the dividends, as I mentioned, was part of that pricing model, part of the value of the option contract. So let's take a look at first what dividends are and how they affect your options contract. First and foremost, again, for those of you new to options trading or new to investing, a dividend is simply a cash payment that a company, a corporation, typically pays quarterly to its shareholders. At the end of the quarter, they will have profits left over, and they decide to share some of those profits with their stakeholders, with their shareholders, in the form of a dividend. Now, the interesting thing here, again, especially for new options traders or new learners to the option field is that dividends are only paid to shareholders. A call holder or a put holder or a call, call writer, put writer, what have you, anybody that has an option contract isn't entitled to that dividend. The only way you get that dividend is if you exercise the contract, and that's something that we'll be getting into shortly. And while I'm not going to read verbatim all of these bullet points, a couple of the relevant issues are that the price of a stock and the price of its options are directly connected, which is something we'll talk about shortly. If the dividend changes, that's going to change the stock price, and therefore that's going to change the price of the option. And then also when dividends are paid, stock is generally reduced by the amount of the dividend. So if we've got a company out there that is paying a quarterly dividend of $1, when the stock goes what's known as ex-dividend, meaning that the stock is now trading without that dividend, and therefore the options also will be trading without that dividend attached to it, we would typically expect to see the shares of the stock to fall by that dividend amount. So if the company pays $1 dividend, we'd expect shares to come down by $1 as well. Now, I apologize here. I just lost my screen. Here we go. Sorry about that. So dividend pricing. As I had mentioned, with all this turbulence lately, companies are slashing their dividends. Sometimes you'll see the dividends going away altogether, or just some type of change in dividend, whether it be an increase or decrease. But how does that affect the option contract? If there's an increase in dividends, we would expect to see put premiums, and premium is the price that you're paying for that option. We would expect to see put premiums increase and call premiums decrease. When there's a decrease in the dividend, which is something that we've seen recently, put prices fall and call prices increase. Now, on the surface, this may be something a little counterintuitive. It may not make sense. When you look at it on the surface, you may think that if a company is increasing their dividend, if a company's paying $1 dividend this quarter, but next quarter they're going to pay $1.50. So I know if I exercise my option contract, my call contract, I am going to take delivery of shares of stock. When I take delivery of those shares of stock, now instead of getting paid $1 dividend, I'm expecting that I will be paid $1.50 dividend. So I'm going to be making more money. Intuitively, you would expect that if I'm going to be making more money down the road by exercising this contract, I might be willing to pay more money for that option, right? On the surface, it makes sense. So intuitively, you might think that if there's an increase in dividends, then call premiums would increase. However, that's not the case. And the reason being is that a higher dividend simply means that at some time in the future, when that dividend is paid, the share price is going to decrease by a larger amount. If the dividend is $1 right now, and that dividend is paid out, I expect the shares of stock to drop by $1. If the future dividend is going to be $1.50, now when that dividend is paid out, I'm going to expect shares of that stock to drop by $1.50. So if I am expecting share prices to fall in the future at a greater level because of that increase in dividend, I'm not going to be willing to pay as much money for that option contract. I'm not going to be willing to pay as much money for that call contract. So while intuitively it kind of makes sense that an increase in dividends would lead to an increase in call premiums, the actual fact is the opposite, and that because the higher dividend will lead to a lower stock price, that is going to result in lower call premiums. And as calls and puts behave oppositely, there's a concept called put-call parity that we'll touch upon briefly today. We will be discussing that concept at length next month when Ken Keating presents a webinar on put call parity, and certainly you can look at some of the resources on our website already. But the point being is, because of this concept of put call parity, when calls go down, puts go up, puts go down, calls go up. So everything kind of maintains a harmonic balance in terms of pricing. So again, just to recap here, dividend pricing, an increase in dividends leads to a decrease in calls, an increase in puts, and then vice versa when it comes to decreasing dividends. Calls go up, puts go down. And we'll take a look at that pricing in just a moment. One of the reasons why it's so important to understand about dividends is this feature of exercise and assignment risk. When it comes to assignment, we had talked about how in order to get the dividend, the investor needs to exercise their contract, right? So when it comes to, for example, one of the most popular investment strategies out there is known as the covered call. Again, for those of you not familiar, a covered call strategy, it's an income generating strategy, whereas you basically buy 100 shares of stock and you sell a call option against it, or you already own 100 shares of stock and you sell a call against it. By owning that stock, you are entitled to the dividend. You are a stockholder, you're a shareholder, you're a stakeholder, however you slice it, you are entitled to that dividend. By selling the call against those shares, you are obligating yourself, if you get assigned, to deliver that stock. And that stock just happens to be dividend-paying stock. So if I'm a call holder, I have to buy that stock before the ex-dividend date. Remember, I said the ex-dividend date is the date upon which the options or the stock trades without that dividend attached to it. So if I'm an option holder, a call holder specifically, I've got to exercise my contract before that ex-dividend date. What it also means is that depending on when that ex-dividend date is, I may exercise my contract early before expiration. If expiration is on Friday and that ex-dividend date is on Thursday, then I need to exercise my contract by Wednesday in order to be considered a shareholder and receive that dividend. And it's 2 days before that option expires. And shortly we'll get into when does it make sense to exercise early and when does it not make sense. But the idea being is when dividends are involved, option sellers are at risk of early assignment. So definitely something to keep in mind, certainly when we're talking about call options. And then here's a rule of thumb as to when to exercise. If the time premium, remember that's that extrinsic value we were talking about, left in the call option is less than the amount of the dividend, then the option's a candidate for early exercise. And we'll go over an example in just a moment to take a look at that. And then back to that put call parity concept, you can look at what that corresponding put is trading for. And if the value of that put is less than the dividend, you might consider covering your calls. What it means by covering your calls, it means that you likely will be a candidate for assignment. And if you don't want to get assigned on those short calls, which would obligate you to deliver dividend-paying stock, then you'll want to manage that position somehow. You'll either want to buy back those short calls to close, so now you only have the stock position and you don't have any obligation to sell those shares. You may want to roll those calls out to a higher strike and therefore lessen the likelihood of assignment, or roll it out for more time. If your options are expiring, say, this Friday and you're worried about getting assigned, you could buy those back to close and sell to open a similar strike or a higher strike next week, or I should say for next week's expiration, next month's expiration, 6 months from now, what have you. You can roll out is the term for that. So if the corresponding put is trading and you are a candidate for assignment, you might want to manage that position if you're not willing to give up that dividend-paying stock. So here's that example I was talking about, to exercise or not. And our scenario is stock is trading $100. We've got 8 days until expiration, DTE, that's days to expiration. And the company is paying a 50-cent dividend, and tomorrow is the X date, meaning that tomorrow the options will trade without the dividend attached. If I want the dividend, I need to exercise this contract today. So the question is, should I exercise or not? And there are a half a dozen different examples here. Let's look at that first one. It's an 85 strike. The market on it is 1480 at 1520. We're calling it in the middle. $15 is fair value. With stock trading $100, the $85 strike is going to have $15 of intrinsic value. That's inherent worth. If it's trading $15 and that's what the intrinsic value is, the extrinsic value is going to be very, very minimal, pennies if at all. One thing you'll notice is that as calls go deeper in the money and as puts go deeper in the money, the intrinsic value, value portion of the premium gets greater and greater, to where the really, really deep in the money option contracts, whether it's calls or puts, have no extrinsic value whatsoever. Their entire value is intrinsic. So in this case, with this 85 strike, pretty much all of the value of the option is intrinsic, very little extrinsic value, a 50-cent dividend. You can see the put is nominal, really not worth anything. If the extrinsic value amount is less than the dividend, then the call is going to be a candidate for early exercise. So in this first example, we definitely know that the extrinsic value is really nothing. The dividend is 50 cents. That's going to be a candidate for early exercise. And let me explain this a little further. Let's look at, for example, the 95 strike. So the $95 strike, it has $5 of intrinsic value. It's only got 10 cents or a little less than 10 cents of extrinsic value. The dividend is 50. When we exercise our option contract, let me just back up for a moment, please. When we exercise our option contract, say on expiration Friday, it's a binary event, right? Your contract is either worth something or it isn't. It's either in the money and it's worth its intrinsic value, or it's at or out of the money and it's worthless. Options will only expire for their intrinsic value, or they expire worthless. A basic options concept. If stock is trading $100 and I've got a 95 strike call, if I were to exercise that call, I would pay my strike price times 100, $9,500, and in return I'd receive 100 shares of stock, currently valued at $10,000. So I could theoretically turn around, sell that stock for a $500 profit. If I were to exercise that contract early, 2 days early, 2 weeks early, 2 months early, what have you, I'm still exercising that contract for only its intrinsic value. Any time value, any extrinsic value in the option is lost. So if I exercise early, in the case here of a dividend, the expiration is Friday, ex-div date is Thursday, here today is Wednesday. If I decide to exercise my contract today in order to capture that dividend, I am going to be losing any time value that's left in the option. So in the example here of the $100 strike, it's trading $1.40. If I exercise the contract today, I am basically paying $100. I'm basically buying shares at 100, and I'm receiving shares at 100. So there's really no economic value to exercise that contract today, except I now become a shareholder. So now becoming a shareholder, I get that 50-cent dividend because I'm exercising my contract and I'm taking delivery of those shares. However, because I'm exercising that contract early, I'm going to be losing that time value. That time value right now is $1.40. That extrinsic value is $1.40. So it would make more sense for that $100 call owner, that call holder, to simply turn around and sell his contract back to the market to close, rather than exercising the contract and collecting that dividend. So that's why there's an N, why there's a no there for that $100 strike. To make things a little bit more, I don't want to say difficult, let's say rather than the $100 strike, we are looking at a $99 strike. And that option is trading for, let's say the option is trading for $1. So if we exercise that $99 strike, we are basically making $1 on the stock. However, we are also collecting a 50-cent dividend. So the time value of the $99 strike, it's $1 in the money. There is no time value because it's only trading $1, and that's how much it's in the money. But we're collecting a 50-cent dividend. So the idea is if the dividend amount is greater than what you are foregoing by exercising that contract early, it is a candidate for early exercise. So what happens when that dividend gets reduced? Well, we've already covered this a little bit. Option prices account for potential dividends. As the dividend goes lower, calls increase and puts decrease. A stock may experience a decline following the dividend, and that's a big issue because again, if I exercise my call and the stock is paying a $1 dividend, stock's trading 100, I have the stock pays a $1 dividend, I exercise, the market is expecting shares to open up tomorrow for $99. It's expecting to be reduced by the amount of that dividend. So it's something to consider when looking at options, call options in particular, what that dividend amount is, because not only is it going to affect the share price, but the share price is perhaps the greatest influencer on the value of the option. Certainly share price, implied volatility, time to expiration, et cetera. Certainly a lot of different inputs, but share price, first and foremost, is an influencer on that price of the option. So the larger the dividend, the greater that option contract is going to decrease in value. The larger the dividend, the more the share price is going to decrease in value, and therefore the value of call options as well. So just something to keep in mind when looking at dividends. And really, again, if you remember nothing of this webinar with the exception of one item, just remember that when it comes to early exercise, whether you're a buyer of an option or a seller, such as short calls on a covered call strategy, remember the rule of thumb that if the dividend amount is greater than the time value lost when exercised, it's a candidate for early exercise. If I'm giving up $1 by exercising early, that's what my time value is on the option. But I'm gaining $2 because now I'm a shareholder and I get a $2 dividend. I have a net profit by exercising early of $1. So, definitely something to keep in mind there. And for those of you wondering, I see that a question just came in from Dean. For those of you wondering about dividends, One terrific website that I use for finding out upcoming dividends and what the X dates are. I don't have the website offhand, but it is on the NASDAQ, NASDAQ.com. It's on the NASDAQ website. If you just Google NASDAQ dividends or NASDAQ ex-dividend date, it'll give you that link, or we can certainly email that to you if you want to shoot us a message. But the idea is that that NASDAQ website is a terrific tool to show upcoming ex-dividend dates on a variety of stocks. So, definitely something to keep in mind. And that also brings up another point. When it comes to your options trading, it is incumbent upon you as the investor to know everything that there is about the stock upon which you're trading options, the stock, the ETF, the index, what have you. Nobody's going to look out for you other than yourself, meaning you need to know when those dividend dates are. You need to know what corporate actions are happening. We're going to be talking a little bit about various corporate actions in just a moment. But the idea is we get calls and emails and chats on a daily basis from investors that aren't as familiar with their contracts as they probably should be. What that means is they may not exactly know when their contract expires. They may not exactly know what is the last trading day, whether it's an AM or a PM settlement, for example, or if it's a weekly contract. When does that option stop trading versus the underlying? We often get calls from sellers that are saying that, well, if the market closes at 3 o'clock Chicago time, 3 o'clock Central, how is it that I have risk up until 3:15 or up until 3:30 or 3:45, depending on when a broker's cutoff time is for an exercise notice? And I'm getting off topic here for a little bit, so I apologize. But we get calls and emails from investors just like yourself on a daily basis that, in my opinion, aren't as familiar with the specific option that they're trading, the specific underlying security that they're trading upon, as perhaps they should be. It's your money. You need to look out for your money because, unfortunately, it's unlikely that somebody else will. Now, us here at OIC, at the Investor Services Desk, we're simply very, very happy to talk to you about your trading, about your options and what they mean and what the ramifications are if there's been a contract adjustment or an ex-div date or something like that. We're certainly very, very happy to talk with you about that. But again, I can't stress enough that it is an incumbent upon the investor to be as familiar with their option contract as possible. And that brings me to our next section with special dividends and option adjustments. And the reason that we want to cover this, again, is because contract adjustments, whether it's a special dividend, a merger, a stock split, a forward or reverse stock split, a bankruptcy, trading halt, something like that, there are a number of events. And the idea being is that, here at the Investor Services Desk, we're very happy to, help you make sense of what those events are, but they happen more frequently than most people would think. And contract adjustments in general are made for, as I mentioned, mergers, stock splits, cash distributions in terms of special dividends, something like that. And it changes your option contract. Your standard option contract is simply 100 shares of stock. For a call holder, you pay your strike price times 100 and you receive 100 shares of stock. On an adjusted contract, as a result of one of these corporate actions, your contract can be modified to where your deliverable is now not 100 shares of stock. Maybe it's more shares, maybe it's less shares, maybe it's a different number of shares plus a cash component. So that deliverable can change. Your strike price can change, as we'll see in just a moment, and certainly the option symbol is going to change. One way to know that your contract is an adjusted contract as opposed to the standard 100 shares is that after the ticker symbol, there will be a numerical suffix. Again, we'll look at that in just a moment. So instead of, ABC stock, December 20 calls on ABC, now it would be ABC1 December 20 calls. So that tells you that it's an adjusted contract. But the point being is that contracts do get adjusted every day, and it's often confusing for investors to really have an idea as to what it exactly they have, what they're getting themselves into, or even how to get themselves out of it. So definitely feel free to reach out to our investor services team to help you kind of make sense of it. So let's look at the case of a special cash dividend. And the reason that a contract gets adjusted for a cash dividend is with a normal dividend, a company announces, next quarter we're paying the dividend, it's going to be X amount of dollars, it will be paid on such and such a date for shareholders of record of such and such a date, etc. And it's a regular thing. It's a quarterly dividend. It's something that investors expect. A special dividend is, or an extraordinary dividend or extraordinary dividend, is it's an animal of a different color. The company doesn't necessarily make the announcement for an event in the future. They may make the announcement saying that we're paying a special dividend to holders of record today or tomorrow, and the market doesn't have a chance to adjust. And what would happen is, in this example, 375 is what we're saying the cash dividend is. We would expect share prices to fall by $3.75. Now, if the market has time to price that in like it does with a normal dividend, then everything is fine. The market is in balance. If it happens overnight or within a matter of days and the market doesn't have time to price it in, then that's not fair trading. So what OCC does is OCC will make an adjustment to the option contract. In this particular case, what they simply do is they reduce the strike price. Before the dividend, you had a December 50 strike call, and it's a $3.75 dividend. After the adjustment date, which OCC would publish a notice, an informational memo, the strike price will change to 46.25. The strike price gets reduced by the amount of the dividend to account for that decrease in share price. Before the dividend, shares were trading $50. You've got the at-the-money call. Now the special dividend creeps up on everybody. Strike price gets reduced. Share price is now 46.25. Your strike price gets reduced as well by the amount of the dividend. Stock trading 46.25. Now your 50 strike call is now a 46.25 strike call. Again, that option is at the money. This ensures that the dividend doesn't automatically put a call holder at a disadvantage. He had a 50 strike at the money call. Now the dividend comes in and stock's only trading 46.25. All of a sudden that at the money call is now out of the money. Well, with this adjustment, that basically stops that from happening. Now we're back at 46.25 with our strike, again, at the money contract. However, sometimes the amount of the dividend, and we'll see this in this example, the amount of the dividend, rather than being a strike reducer, the amount of the dividend will be attached to the deliverable. In the example here, let's say shares are trading $10 and the company announces a $5 dividend. If we reduced the strike prices by $5, and with a $10 stock, maybe you've got a $2.50 strike. or a $5 strike or a $7.50 strike. If those strikes were reduced by $5, that $5 strike is now a $0 strike. That $2.50 option is now a negative $2.50 option. And obviously we can't have 0 strikes, and we certainly can't have negative strikes. So what OCC would simply do is they would, rather than reduce the strike price, they would simply attach the cash equivalent of that dividend to the deliverable. So before the dividend, you can see in our example, we've got a $10 call. Now after the dividend, you can see that the option symbol changes to XYZ1, so that tells us it's an adjusted contract. And now that XYZ1 $10 call comes with a $500 cash deliverable. So again, that numerical suffix is how we determine whether or not it's a standard 100 share contract or not. And it's important to know because they're, again, two different animals. Your standard 100 share December 10 call, if stock was trading $7.50, is out of the money by $2.50. It has 0 intrinsic value, and likely the market on the option would be, no bid at maybe a nickel. However, that XYZ1 December 10 call, it's got that $500 of cash attached to it. So with stock trading $7.50, if you were to exercise that $10 call, you would pay your strike price times 100 or $1,000, and in return, you'd receive 100 shares of stock plus $500 in cash. So the equivalent is that you would have a $250 profit or $2.50 of intrinsic value. So likely the market on that option might be $240 at $260. The reason I point it out is because unless the option holder or writer is astute enough to realize the difference of those two contracts, you may end up buying or selling a contract that you don't fully understand the deliverable. I had an email conversation with a gentleman several months ago that unfortunately bought an adjusted option contract. There was some shares of an ETF that underwent a reverse split. He saw that the option seemed to be very, very deep in the money and yet was trading for a very minimal amount and invested a good chunk of money buying these calls only to find out that the calls were worthless because the deliverable was not the standard 100 share, but the deliverable was only 2 shares of stock. Needless to say, he was very, very frustrated and very upset. But the point being is that the more education that you have when it comes to trading options, the more you learn about the different nuances and intricacies of different contracts. In this case, we have something that some of you may have learned today. In addition to the exercise, the early exercise rule of thumb that I gave you about the time value and the dividend amount, another takeaway is adjusted contracts. If there is a numerical suffix at the end of the ticker symbol, it means it is an adjusted contract. If you don't understand what that adjustment means, definitely get in touch with us here at OCC and we'll be happy to explain it to you. So, that being said, I want to encourage everybody to make use of our investor services team. You can reach us on our website at optionseducation.org. We've got live chat where you can have a one-on-one interaction with us. You can simply or certainly email us for more information. Our previous webinars, our archived webinars, you can find on our OIC YouTube channel as well as our main optionseducation.org website. I would also want to take a moment to encourage you to visit our new learning management system that we just rolled out about 2 weeks ago. We've got a whole new interactive learning management system with podcasts and videos, and we are in the process of creating new options education courses. Right now we've got a course uploaded called Introduction to OCC that gives an overview of what OCC does and our role in the options industry. And as the weeks and months go by, we will be adding new content, so I certainly would encourage you to explore that. Let's go ahead. It looks like we've got about 10 minutes left, so let's take a look at some of the questions that we have in here. Let me see. I apologize for the delay here. I'm just kind of scrolling through, and they keep. Again, there was a question on the NASDAQ website, X dates. Does it just give X dates for NASDAQ stocks or all stocks? I believe that is all stocks, but you can take a look at that website if you would like. Here's a question about pricing. Doesn't the market maker determine the bid-ask spread? The answer to that is it depends. If the market maker, if it's a thinly traded stock, then the market maker may be one of the few market participants to trade that stock, and therefore they determine the bid-ask spread based on the exchange policy and parameters. The exchanges have policies with the price of a stock that if it's X amount of dollars, the bid-ask spread can be no greater than whatever that price may be. Let's say $2. If it's a higher price stock, maybe that bid-ask spread can be $4. If it's a higher price stock, maybe the bid-ask spread can be $10. The point being is that, yes, the market maker has an obligation to provide a bid-ask spread for those particular stocks. However, there's nothing to prevent you or I or anybody else who's interested in trading options on those stocks to put in whatever bid and ask we so choose. If I'm the market maker and I make a market a dollar bid at $1.50, but you're interested in buying, there's nothing to prevent you from putting in a $1.20 bid or a $1.30 bid or a $1.40 bid, what have you. There's nothing to prevent you from changing that market, improving my bid, or improving my offer. And in doing so, that will be reflected on the big board, right? That will be reflected on every trading screen, across the country and across the world. They will see that, the market was a dollar bid at $1.50. Now, Ken from Kentucky they certainly won't see your name, but now they'll see that the market is a $1.20 bid at $1.50. And now that I know that there's an interested buyer, I might be willing to sell a little bit less. Maybe I come in at $1.40, you bid up to $1.25, et cetera. Like I said, it's a negotiating process. Obviously, sometimes some of the more actively traded securities and ETFs out there have very tight markets where you've got high volume, you've got a large amount of open interest, and it's basically easier to get in or out of an options position at a more advantageous price. And that's why you see some of these stocks that are heavily traded, you might see a market of 125 at 126, right, a penny wide. And it certainly takes the guessing game out of that equation as to whether or not I want to buy it or sell it. A penny here or there a penny equates to what, literally $1 in the real world. So obviously if I'm buying, thousands of these contracts, it might make a difference. But, if I'm looking to buy 10 contracts on a stock that or 10 option contracts on a stock that I really like or I may really not like, depending on my market bias. But the point being is, if I really want to take that position, a penny here or there really isn't going to make much of a difference. Certainly, a difference between market orders and limit orders, even though a penny may not be all that much of a difference. If it's a market order, it may be significantly more than a penny, simply because you never know what's going to happen with that market prior to that order being filled. Again, spoke with a gentleman the other day, a very wide market of, I want to say it was 50-cent bid at $6 ask. He put in a market order thinking he would be filled somewhere in between, and guess what? He paid $6. And immediately whoever sold him that contract at $6 then turned around and tried to buy it back for maybe $4 or so. So the point being, definitely a difference between market and limited orders and limit orders. But in terms of who determines that bid-ask spread, again, you and I, any market participant. So let's see another question here. What happens when a stock merges with another company? Does your broker just cash you out? When the merger happens, do you get paid at a better rate? In terms of the stock, we can't, I can't speak about what happens with the stock. The OCC Options Clearing Corporation, as well as the OIC, our services are limited to the option contracts. I can tell you that when it comes to the option contracts, our corporate action team will put out a notice explaining how that option contract is going to be adjusted as a result of the merger. Typically, they do follow the shares of stock. So if Company A buys out Company B for cash and you've got options on Company B, that cash amount will typically be the final settlement price. If it buys it out for, say, $55 cash, that's going to be the settlements. The options are basically going to settle to the intrinsic value based on that $55 amount. What also would happen is that now that that final settlement price is known, any remaining time value of the option disappears, and we would expect the option contracts to be accelerated to expire at a sooner time. Let me go, let's see, another one. If a company gets delisted, while these questions don't necessarily pertain to what we've been speaking about today, for example, this delisting question, we have been getting a number of these at the investor services desk. Again, due to these turbulent markets, a lot of these ETFs are folding up. Some companies are being delisted for one reason or another. If shares get delisted, what happens to the options? Well, the options continue to exist. Typically, the exchanges will allow closing-only transactions, meaning if you are long the contract, you can try to sell it to close your position. If you're short the contract, you can choose try to buy it back to close it. You typically would not be able to open any new positions. However, something to think about is, number one, typically when a company gets delisted, there are no exercise restrictions placed on that security by OCC, meaning if I'm a call holder, I can still choose to exercise my contract. If I'm a put holder, I can still choose to exercise my contract. If I am a writer, either call or put, I am still obligated to fulfill the terms of those contracts. One caveat, something that we point out to put holders for specifically, is while the OCC may not have any restriction as to what they can do with that put contract, their broker may have a different story to tell, in the sense that their broker may not allow a put holder to exercise their contract if they are unable to deliver those shares. So if you're a put holder and you don't already own those shares in your account, your trading firm may prohibit you from exercising that long put, whether, if shares are halted, if the company gets delisted, or even for that matter, even if nothing happens, you'll always want, as a put holder, you'll always want to check with your broker as to what their policies are in terms of exercising a contract, specifically a delisted or halted contract. So I hope that answers that question. It looks like we're just about out of time, and I see that my team of Ken and Bill seem to have answered dozens and dozens and dozens of questions. So ladies and gentlemen, certainly thank you for your engagement. Thank you for sending your questions to us. We certainly appreciate that. And thank you for attending today. I always love to see the large number of investors that we're fortunate enough to get to attend these events. It's wonderful to see how engaged people are when it comes to investing and managing their money. Again, like I said, it's your money. The person who should be most invested, no pun intended, in your money is yourself. And the best way to do that is to get as much possible education as you can, and certainly here at OIC, we love providing that education to you. So, before I say goodbye, again, I just want to thank you for attending. Thank you, Bill and Ken, for taking all of these wonderful questions that seem to have been coming in. At the end of the presentation, there will be a survey that pops up. Please let us know what you thought of the event. Let us know what you thought of me as a presenter, whether or not I'm too long-winded. Sometimes people often tell me that I love to hear myself talk, which unfortunately I'm guilty of. But I also want to invite you to make use of our investor services team. It really is a great service out there, free education, free a sounding board for you to bounce your ideas off, to ask questions, completely free service. We don't provide recommendations, we don't provide advice, but we simply will give you as much education as possible so you know what you're getting yourself into and how to trade options responsibly. So again, ladies and gentlemen, thank you so much for joining us today. I hope everyone has a wonderful rest of the week. Please stay happy, please stay healthy, and good fortune trading. Take care.